Hey, yeah, what? Grab your bootstraps, yeah, let's scale your growth. Here's the truth, Jack. We'll reach the globe, unveil the notes.
What the fuck?
Earn your digits, won't burn, you'll get it. See, this is factual. Funds will show, learn to flow with Candid Capital.
This is a Candid Capital interview. In these episodes, we host industry business professionals involved in the global tech ecosystem to discuss various topics related to tech, global economy, and building sustainable businesses and investments.
Welcome back to the Candid Capital Podcast. I'm your host, Josh. In this episode, the discussion will be on the SaaS metrics, specifically highlights from the most recent SaaScan report. The market dynamics have shifted, and so too the weighting of importance for some metrics when assessing the health of SaaS businesses as an entrepreneur or an investor. Joining this episode to dive into the key metrics in the SaaScan report on the Canadian market is Lauren Thibodeau, CEO and founder of SaaScan. Hi, Lauren. Thanks for joining me. How are you?
I'm great. Thanks, Josh. Great to be here.
Yes, I'm really excited about this episode because, as you're aware, I'm an analyst and I like to geek out on metrics sometimes.
Well, let's geek out on them together. I love it.
So before we get started, I typically like to get the backstory, of how people ended up where they are and kind of the journey. So if maybe you can just give me a little context as to your entrepreneurial journey and how you ended up getting into metrics.
Yeah, I'd love to. And I would just start by saying I was kind of an accidental entrepreneur. I didn't even know what a startup was, but I actually created one in university to help fund my studies. And I ended up growing a business that was super niche, doing French language instruction for homeschoolers and sales professionals that I grew to 30 clients in 2 cities. And no one in my family was an entrepreneur. I just loved it. And I built a very small business, but got a taste of really that impact you can have quickly as an entrepreneur. From there, I really moved into entrepreneurial builder type roles in larger organizations. And so helped Queen's University build out its very first executive MBA program, and then worked inside larger companies to build out new programs, new divisions, new revenue streams before launching off on my own to really, run my own consulting practice and then start SaaScan.
What was the draw? What pulled you in? Because like most people, with entrepreneurship, yes, there's the I love it or I hate it, but there's also kind of a lot of risk associated with it. Versus taking sort of the safe path. And so what was it that drew you in?
Yeah, I think it was probably 2 things. I think it was a drive to do something that would bring high returns so that I could fund my school studies. And working at McDonald's for minimum wage did not appeal to me. I wanted to do something higher impact, higher value, really specialized, that really people weren't doing. So that was what fueled me initially. After that, I just loved building. Like I get bored with the status quo, and I hear that from a lot of entrepreneurs. I took kind of a safe route, though, I would say. I was an entrepreneur within a bigger, more stable company for a long time, until 4 years ago when I really cut all the cords and totally branched out on my own. I knew I could do it. I just didn't know how long it would take. And so, yeah, my first couple of months, there was 0 revenue. And then gradually, it ramped up from there.
So when you were doing, I think the term is entrepreneur.
Yes. Yes.
So in the organizations you were in, like, did you have a lot of flexibility and freedom? Did it keep you kind of siloed? Or did you still have sort of a very command structure type of situation?
Oh, well, the 2 examples I'll think of top of mind, it was very, very flexible, empowering, not a lot of restrictions, which is why I was able to thrive there. So, for example, when we launched the Executive MBA program, it was basically a separate business unit, and we had carte blanche to build, to innovate, to really use different models, different revenue models, and start from scratch to build something. So that was very arm's length and very entrepreneurial. In one of my more recent roles at Kinaxis, which everyone knows about here in Ottawa anyway, some of your audience might not, but supply chain planning company where we created a whole new division. And so there was lots of buy-in from the top, and we had to really keep everyone informed, but able to build a new revenue stream, convert some services revenue to subscription revenue, and 10x over 3 years what we were doing. So that was really exciting.
Yeah, no, that is very interesting. I don't recall. Does Connexus do corporate venture as well?
So I couldn't speak to that side of it. I was always in-house, an executive kind of building functionally from within. So I couldn't really speak to that part of it, but I know that very entrepreneurial, and their trajectory's been, quite impressive over the years.
Yeah, because I'm always interested in sort of, these companies that do the entrepreneurship, and then at the same time they're kind of doing venture.
Ah, yes.
And then they decide either they're going to pull them in or not pull them in, and then how that's going to kind of work in there. That was kind of the context of the question.
Yeah.
No, that's really cool. And so from there, is that kind of how you got into metrics?
It is. Well, when I really decided I want to run my own business again and really be an entrepreneur as an advisor to SaaS companies, I focused on customer success, and a lot of, assessing early on is based on metrics. What's your revenue growth rate? What's your churn? What's your revenue churn? Are you expanding revenue? So I was using metrics really as a diagnostic tool to understand the health of the businesses I was helping. And what I noticed was when COVID hit, metrics went crazy. Metrics went haywire. People didn't know what to expect. The sky was falling. And there was so much interest from the SaaS founders, the CEOs, the investors I was speaking with around what's going to happen to retention, what's going to happen to churn. And so I just tossed out an initial survey and was overwhelmed with the response from Canadian SaaS companies. Here's what we think is going to happen to retention and churn. And then we did a follow-up 4 months later, another strong response rate of what actually happened, which was about half as bad as people thought it would be. But what it told me was it wasn't just me who was interested in these metrics in the Canadian SaaS world. There was lots of interest from founders, from investors, from incubators, accelerators. And that was really the spark from which SaaScan was born. There wasn't a lot of research out there. There are strong benchmark studies that do exist, but there wasn't a Canadian-centric focus, and Canadian companies were really not well represented in those studies. So that's where it came from.
And I guess, what is the big, differentiator or maybe a metric that you notice that maybe Canadians outside of economic macro events tend to really either focus on or favor versus maybe, say, another market or the US? Did you come across anything like that, or is it all the same?
I have a hypothesis, which I haven't proven yet, but I hope to be able to prove out over the next couple of years. And there's just, I think it's common knowledge, there is a much larger pool of capital in the US going into US-based companies. There's a smaller pool, but growing in Canada. And my hypothesis is that Canadian SaaS companies are more capital efficient than, say, US-based companies as a collective. I don't have data on that yet, but that's something that I am watching really closely on their efficiency score, right? How much net new ARR, annual recurring revenue, can Canadian SaaS companies generate from every dollar they're burning? And how does that compare to US companies? So let's put the watch out on that one. We're about to launch a new benchmarking study. It's a hypothesis, not yet proven, but let's see.
And I would love to see the data on that kind of correlated with the cultural, I would say, entrepreneurial risk profile of Canadians, because we are described as being less risky. And I'm wondering if that has any type of relation to potentially maybe the requirement to be more capital efficient.
Yeah, you're right. That would be a really interesting comparison to make. And yeah, would love to see that too.
And so SaaScan was born out of COVID then?
That's right. Totally born out of COVID, and just kept sort of seeing, is there interest? Is there continued interest? Could we generate more research? And so SaaScan really focuses on helping Canadian SaaS startups under 2 million in ARR, kind of pre-Series A, on understanding the metrics they should focus on, what great looks like based on benchmarks, and empowering them one-on-one to focus on the right things at the right time. That's our main focus. We also do research up to the $5 million mark and beyond, but really we're mostly about helping startups succeed early on so that they're on the right path.
Okay, cool. I did see the latest report that you had out, and that's really what led us to doing this podcast.
Yes.
As myself, I do a lot of valuations and watch the market. And so I thought it'd be really cool to kind of talk about the ranking that you have for the different metrics.
Yes.
And so I believe you had highlighted 43, it was either 38 or 43 metrics total.
Yes, there were so many. There were over 4 dozen metrics that came back from investors that people could measure.
And okay, so this came from the investors, not the companies. So
Correct.
There's not a company out there with a dashboard with 43 metrics that they're using to report to their investors.
I sure hope not. But let me set up the context of this study for you, because I think the audience would be interested. So we went out to investors and lenders in Canadian SaaS. Most of them were Canadian investors or lenders, but there were some US as well. And we asked them at 3 different stages of company growth, what should SaaS founders focus on? What are the top 2 or 3 metrics they should focus on when they're under $1 million in revenue, when they're between 1 and 5 million, and when they're over 5 million? And so they came back with over 48 different metrics, but there were very clear patterns in what the top 2 or 3 were per stage. So let me just walk you through them if I could.
Yes, please.
Yeah. So under $1 million in ARR, they really advise founders focus on making sure you have product market fit. But number 1, make sure you have enough runway. Don't run out of cash. And this changed pre-pandemic to post. Pre-pandemic, they were guiding maybe 12 months. Now we heard kind of 18 to 20 months runway they wanted companies to have. So that was a big change. So runway, revenue growth rate, not surprising. How quickly are they growing their revenue? And also usage. At this stage, revenue, you're under $1 million. Your revenue is maybe not the highest indicator of stickiness and traction, then your usage is. If you're expecting, you have a financial software product, you expect founders to be coming in end of every month or users to come in for their financial close, like how does their product usage compare to what you expect? Daily active users, weekly active users, monthly active users. And when you segment that by your different types of customers, what patterns do you notice? So investors and lenders got really, advised SaaS companies to focus on those metrics early on as a sign of future traction.
And so I just wanted to clarify for lenders and investors. So we're talking about angels, venture capitalists, and banks?
Yep, that's right.
Okay. And for the banks, I'm assuming maybe something more like Silicon Valley Bank type of lender versus a traditional bank?
Yeah. So SaaS lenders. So SaaS Capital was a participant in the study. Tamaya Capital was a participant as well. So, banks or financial institutions that really have a SaaS focus, investors who invest in SaaS, lenders who loan based on the SaaS model. Yeah.
And I would guess that maybe different investors and lenders had different preferences in the types of metrics as well.
Yes, they did. They certainly did. And that's where that broad range of 48 different metrics came from. And so what we looked for was where were the commonalities so that we could advise founders, because that's our main audience is SaaS founders themselves. We could advise them, hey, these are the most common things that investors and lenders tell you to focus on under $1 million in revenue. runway, revenue growth rate, usage. Yeah. At the next stage, once they start growing, growth rate, revenue growth rate, just let's assume that continues throughout because it does. They really wanted founders to focus on the lifetime value to customer acquisition cost ratio, that LTV to CAC, and then net dollar retention. How much, once you sign a customer, how much further can you monetize that same customer by selling more, by adding on new functionality, by growing the user base? That's huge for SaaS valuation over time.
Yeah, I noticed that as well. If we were giving out an award each year for like metric of the year, it seemed that net dollar retention was the one I would say of 2021. It's the one that a lot of different VCs were talking about. Yes.
And I love that. If we were to give out an award, I would say that would continue even through 2022, 2023. The other one, and it came out of this 1 to 5 million ARR range as well. The other one I think people would get awards for would be efficiency. This efficiency score. I was actually on stage at SaaS North recently with a VC, a founder, a CFO, all in the SaaS space. And we said, what's the one top metric above all else you would like to look at any stage? Efficiency score. How much revenue are companies generating for every dollar they're burning? And best in class, over 1.5x.
Yeah, I started to hear that one more, I'd say in the second half of last year.
Okay.
It's definitely still, which is why I agree with you. I would definitely have it, it'd be a close one between deciding who's going to ultimately get the award between those two. But, but I would say that other one started to show up more towards the end of the year, especially when everyone was being told have an 18 plus month runway. Don't expect, to raise any capital. But the capital efficiency, I have some, perhaps controversial thoughts on it.
Okay.
And again, I have no data to support any of this. It's anecdotal, I guess you could say.
Mm-hmm.
But I feel like this industry, and particularly venture, has never really been about capital efficiency, particularly in the early stage.
Mm-hmm.
It's been about growth.
Yep.
And the risk profile has always been high for venture specifically, and I would even argue to a certain extent angel. But what's different, and not just because we're going through different economic situations at the moment, but a lot of these venture firms are starting to look more like Wall Street funds.
Oh.
They're very, very large. If you look at the capital that was raised last year, it was like unprecedented numbers.
Yes.
But it's over 70% of it went into the same firms. And some of these firms are looking like funds of funds. Some of them are looking like hedge funds.
Yeah.
And they have different types of LPs. Than like the old school 90s, we'll say, venture capital firms. And so a lot of it is starting to look a little bit more like the financial industry.
Interesting.
And those groups tend to care a lot more about capital efficiency because they can't take losses the way a venture firm can.
Yeah.
And they are more accountable, to the types of LPs that they have. And so I'm also wondering if, some of these funds also structuring into a venture firm, so to speak, different tax rules on the upside as well. And so I'm wondering how much of this capital efficiency is being influenced by, we could say, more mature venture firms or more mature financial funds entering into venture. Because we have so much PE involved in it now as well, which also tends to like capital efficiency because they need EBITDA.
Yeah. Yeah, that's a good point. So, I have some data on the driving objective that investors and lenders, and we did not get data from any private equity firms in this study. So I'll call that out. So this is really angel investors and early stage VCs with a couple of SaaS lenders in the mix. What was fascinating to me is a couple years ago, if you'd asked at that $1 to $5 million ARR stage, because we did, what's the main objective? It was growth, 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 run with scissors, growth, growth, growth. Now, people actually, when I tested the initial version of the survey, I had growth. What's the key objective SaaS founders should focus on? Pick either growth or capital efficiency, or, we had a bunch of choices. They actually typed in growth and capital efficiency together, cannot separate, must be both together, growth and capital efficiency. And so it was really an interesting shift. And that was very much a common trend across that stage of investor from 1 to 5 million ARR, where I'm looking at the numbers now. 40% of them said growth and capital efficiency together. 26% said growth and 20% said capital efficiency. Like, it was just neck and neck. You had to have both as a founder this year. So interesting shift.
So I have another no data related kind of thought on that, and specific to SaaS is, and it kind of also relates to lenders, because now there's more of a lending market for SaaS companies where there wasn't before. Right. A lot of SaaS companies are not, I would argue, they're not innovative and disruptive. What they are is digital transformative.
Yes.
And so what it kind of looks like is the traditional SMB that was a brick and mortar with physical goods is transitioning into a software SMB market. And so if you look at it from that lens, and you're kind of building these lifestyle businesses that would be equivalent to mom and pops, 3-4 chains, then you would have more lenders involved, and you would have capital efficiency is more important. So that's kind of like another, I guess, part of the story that I kind of think about in these terms of things.
Yeah, no, that's really interesting. And again, that didn't come out in our data because we were talking to VCs primarily who are looking at venture scale businesses. But you're right. I like your thread on digital transformation. That is probably the vast majority of what's being created today. I've also recently gotten involved, just dipping my toes in the angel investing world myself, and focused on increasing the pool of women-led capital in women-led companies, because it's gone down year over year. It was 1.9% in 2021 of all VC funding invested went to women-led companies, down from 2.8, down again 2.3%. And this is PitchBook, some PitchBook data. But
do you think maybe it's demographics? Like, the reason I'm asking that is because the millennials are in sort of the child decade. Like, I'm a millennial. So, I'm in terms of that, it would be kind of the time that you're either just starting to have children or just about to move, like they're going to go to elementary school or whatnot, so you can jump back in. So do you think that had an impact on that? And do you see the curve going the other way? Now, just based on sort of like the family planning for the demographics.
Do you mean the maturity of women-led companies?
No, that more women are going to be out there looking for capital than previous years, because now they're a little bit older. And so they would have more time to put towards that, because being an entrepreneur is almost 24/7 type of situation. And so if we're just looking at, let's say, the demographics of just millennials,
right,
they're in that sort of 30 to 40 age range.
Right.
And so for like Canadian families, it's typically, the early to mid 30s that you start having the family.
Oh, interesting. I don't see that actually having any impact at all.
Okay.
I see lots of female women-led companies pitching while they're 9 months pregnant, coming back to work after 6 weeks. Like
No, but I meant it in terms of, do you see a more aggressive request for capital from women, like the upsurge of demand? That's what I meant. Sorry.
Yeah. Okay. I understand that. Yes, I see a lot more women-led companies out in the marketplace with incredible businesses disrupting new spaces. Femtech is a huge one that's been incredibly ripe for disruption. There I see disruptive innovation. And I see a bigger pool of women out leading amazing companies. I don't see the trend yet shifting where they're receiving a proportionate share of the VC pie. We need to build a bigger pie of funding.
I mean, I don't know anything about the receiving end. Again, I was just kind of looking at it because like whenever I'm looking at different international markets, I do a breakdown of demographics of different areas for, investment evaluation.
Cool.
And then also I have some friends who are kind of just starting to get back into, we'll say the work mode. And so like, I was just like noticing like their age in relation to mine.
Ah, yes.
And so like, I was just thinking that, maybe the demand for it will increase over the next couple of years.
That could very well be. Yeah, it'll be fascinating to follow.
In general. But no, that was cool.
Yeah.
The other comment that you had there, that you were saying, a lot of them were saying they needed growth and capital efficiency.
Yes.
So I think that might bring us into the conversation of the rule of 40.
Yeah, absolutely. So when we get to that last pool, over 5 million ARR, the rule of 40 is sexy again. Like it came back in style, and really that came through. The top two after revenue growth rate for that over 5 million ARR stage were rule of 40 and gross revenue retention. So really investors and wanted to see, that trade-off between growth and profitability going back up and to the right. And that was huge, which it hadn't been as prevalent previously. So you nailed it. Absolutely. And then probably due to the economy, was this focus on gross revenue retention as you get more mature. Are you even holding on to the revenue from your existing pool of customers? That's very much driven from slower sales cycles, economic slowdown, like just holding on to every penny you can from your existing pool of customers, getting creative on how you retain them, even without expansion revenue, but much more focus on that as you grow.
So for the rule of 40, now I can't remember which firm had stated this, but they were suggesting that it should be like the rule of, I think it was 60 or something like that.
Yes.
And so what is your opinions on this? Should we be sliding the scale on this, or is 40 still the golden rule?
I hear different things. I think it depends probably on the stage you're at in your company as well. It's really profit, right? Profitability, profit margin, and growth percent. So I don't have a strong point of view on that. Higher is better, but baseline yourself where you're at and move it up from there. Really. I think it'll vary. There's some industries, there's some markets where you just can't, there's not a readiness to purchase yet. The growth rate is really hard to get up. Who's in market? Who's ready to buy? Saw a great piece on this yesterday from Gainsight and their CEO talking to Allison Pickens about like who's in market, who's ready to buy. The market size might be huge, but there's only a certain percentage that you can attract each year and the growth will flatten. So where are you in your company maturity? Where is the market in its maturity? And where, how do those things align?
And so there's going to be some differences for the lenders for sure, but did you in your data maybe see if there's a difference in where the scale of rule of 40 is in Canada in comparison to, say, the US?
We haven't yet. We didn't have enough data to compare that side by side. But again, that would be fascinating. That would be fascinating to see. I look forward to doing that kind of analysis in the future.
Because I suspect when you do your analysis on demonstrating or determining, I should say, if Canada is more capital efficient, then that would probably give an idea maybe of that, where that is in comparison to the US. Because, it also kind of makes sense where one of the reasons of many, but our exit path is typically acquisition. Mm-hmm. And so for acquisition, you have to be capital efficient to really sell your company, and particularly at a good valuation.
Yeah, that's a great point.
For that. Whereas in the US, it's all about the IPO, right? That's what you're aiming for. I mean, that is not the most exit path. It's still acquisition in general, but that is what you're aiming for with those like high levels revenue growth
Yeah.
in kind of, worrying about capital efficiency later, if you can keep the run going.
Interesting.
So for these different metrics, which one is your favorite?
Oh, see, that's a great question. What I would say is my favorites actually aren't reflected terribly strongly in this data, because to me, a lot of these metrics are lagging indicators of success. So your net revenue retention, your gross revenue retention, your growth rate, all of those lag what your customers are doing earlier. And so my favorite metrics are earlier customer-centric metrics that will help you understand how to pull the levers to increase things later on. So I love to think about customer metrics in 3 levels and measure them early in the customer life cycle. So customer behavior, which actually did come out. What are customers doing in your software? Customer sentiment. So things like Net Promoter Score. Are customers willing to recommend you? Customer effort score. How much effort does it take for a customer to onboard with you, to have a customer service interaction? That's a huge driver of loyalty and expansion willingness, and even customer satisfaction with the product tool set. So that's sentiment, which NPS comes out a little bit. I think it was rated number 7 in one of the groups, but it's not at the top. And I understand that from the investor and lender perspective, that's not going to directly tie to evaluation, but for a founder and an operator, looking at those customer-centric metrics will give them so much, leverage earlier in the cycle to drive change. So
this is probably higher on the founders list.
Absolutely. It should be. And I'm finding more and more forward-thinking founders are including that customer lens throughout the journey. So yeah, I would say customer behavior, customer sentiment, and then customer outcomes, and being able to actually measure how much you're increasing customer ROI, how much you're saving your customers by using your software. What does the CFO care about in your clients to be able to purchase your solution? Because that's really where we're at today.
And so for these different ones, though, like, for example, would customer behavior, how good would that be when you're in the first category? Because wouldn't you need a large enough grouping set to be able to determine that that's really the customer's behavior rather than an individual? And I'm just thinking, because like less than $1 million, revenue, that could be like 4 customers.
Yeah, it could be 4.
For example.
You're right.
Whereas these other ones, they definitely do make sense. And again, like, I'm not saying either or, I just mean like at what stage do you, like how you have it grouped in the report from the data is that different metrics are more important at different buckets of stage.
Correct.
So do you view these customer metrics the same way? Or do you think just all of them should be focused on the entire way through?
I think you want to start tracking them early, under $1 million ARR, to learn. I think you want to track them throughout all the stages. I think early on, you're just learning. You're seeing, are there any cohorts that are behaving differently? Once you get 10, 20, 30 customers, are there patterns? Like, you're observing and learning early on versus later, once you pass $1 million, 2, 3, you can actually use it to predict behavior and to start to really take action. But I think you need to start measuring it early, develop a really simple measurement program to put in place so that you're seeing these patterns early. Often when people are finding product market fit, they're just still they'll sell to anybody with the pulse initially. That's the instinct, and we get it. But as you're figuring out who your ideal customer profile is, you can often segment based on usage. Hey, we noticed that, there's a bunch of customers who are coming back all the time. They're using our product way more than others. What's different about them? It actually helps you nail down your ICP early on. So it's more from learn early and then use that to inform how you're going to predict behavior down the road.
And so I would make an investor caveat here on these metrics. And also, because I do some valuations, I always want data. So I would receive your 48 metrics
Yes.
from
Yes.
anyone's company. But the reason that these are interesting to me are really on two sides. So if I'm looking for really a high growth company, and yes, you can just look at the, ARR growth, but the thing is, there's so much you don't know with that number isolated, what the reasons are for that growth, which requires a deep dive. But if I'm, for example, wondering is this going to be a unicorn? Is this disruptive? Is this a market maker? And I think for those types of companies, the customer behavior is really key in looking for that trend. Same with effort, satisfaction, sentiment, all those areas really kind of give you that information. And so if I was looking at a company trying to determine, do I think this one is up and to the right? Do I think this is going to be a unicorn? Or is it going to be what's the other one, a centaur or something like that? Yeah. I would be looking at different things. Like I would be looking at the trajectory of growth in a different way, and how I'm viewing, if I invest in this, what do I think my return will be, et cetera, et cetera.
So I love that. And I think, so there's one investor in particular out West who actually looks a lot at Net Promoter Score and really wants to understand how virally are customers going to recommend this to other customers. And virality is really a key indicator of, is this a market maker? Is this the next big thing? Like if you can get, because people really have lost a lot of faith in what companies say in their corporate marketing. People believe other users and peers, and that if you can get customers virally speaking about your product, that's going to create a buzz well beyond anything you could do in your own marketing. And so I have seen some investors who really, really rely heavily on this as a signal for something that's, holy cow, everyone's talking about this unprompted, unsolicited. Why? What's it got? That's maybe a hidden gem behind it.
Well, I definitely do go and look at peer review sites when I'm doing my analysis.
Great.
And on certain ones. And, it's like any, I'm not looking for perfect answers and, a million, but it's to get sentiment. And I do that, and I will cross-reference that with some of their social media activity as well.
Cool.
Because if they have zero social media, it's a flag. That's a red flag for me. Because I find we're living in a world now where products rarely sell themselves unless you are that special first unicorn that came, like if you're the first Twitter or Facebook or arguably Chat GPT. Then your product can sell itself. But the thing is with SaaS is so many of these products are very similar. They have so many substitutes and whatnot. And so if I'm looking at a SaaS company, which of course the founder always says they have no competition.
Yeah.
But they have zero traction in media at all, like in social media. And the thing is, if you haven't been around long enough or you don't have enough good customers in order to get the peer reviews, but nobody's talking about you at all. And yes, of course, you can go and game it and whatnot, but you're not looking, it's not an absolute answer to the value of the company, but it's just part of the formula of
part of the full story. At the end of the day, people behave in a certain way. And so understanding their motivation and what they're saying is huge. Yeah.
And the other piece I would say is why I also find those metrics interesting is, we talk a lot about digital transformation, in our industry, because it's still happening.
Absolutely.
There's still a lot of industries that are not using a lot of tech at the moment. But the other thing is, I think our industry itself is also having its moment of digital transformation. which is how I view Web3.
Okay.
And so in the Web3 space, community engagement is a big piece of it. And so I think that these metrics that you've described here, and then maybe tying that into your community engagement and management, I think is going to be a big piece for companies that we start to find doing the Web3 activity outside of, the crazy stuff like crypto, NFTs and whatnot.
Well, I think you're absolutely right. And this is an area where I don't have a lot of data, but I feel like since we were all locked at home for a year or two during COVID, there is a desire and draw to be part of a community even stronger than it was before. I've seen the rise of increasing, Slack communities, really specialized. I've seen companies standing up. I mean, community's been around for a while, but I think we're keen to connect. And so if a company can harness that, to your point, and really get some good metrics around community engagement, community use, how does that relate to customer stickiness over time? Are they more willing to recommend? I mean, Salesforce is a leader here in their community and has shown people active in the community buy more software, full stop. And so how do we harness, the right metrics, build the right sense of community to kind of, get that going as a flywheel over time? I love that.
I mean, we even had an eccentric billionaire buy the entire community of Twitter.
Yes. Cannot wait to see how that story evolves, like the rest of the world. Yeah.
But yeah, no, like I found a lot with the Web3 community, and some of the conferences I've gone to, like Collision in Toronto and Web Summit in Portugal. Like they're all really sort of, I would describe as community first.
Okay.
And I just ended up dropping into all these different groups, and even some of their technology of what they're building is designed around community. And for example, one of the other episodes that I had was on a marketplace for NFTs, but the community all has to be in the same place to be using these NFTs for other people to see it, because they're skins that go on your avatar.
Yes. Okay.
So, you need your community to see, I just got this new jacket, NFT or whatnot for their avatar. And apparently this is a thing in the gaming industry.
I have a teenager who's all into skins for their avatar and paying real money for digital pixels. I mean, it's a thing. It's a real thing that's growing. Yeah, 100%.
And so, I think that this, at least for the Web3 companies, I think the community management component and the metrics associated with that will definitely be important. So for these metrics that you have here, so let's just discuss a little bit of comparison. So we talked anecdotally a little bit about it was all growth before.
Yeah.
And then we moved into COVID and kind of capital efficiency.
Yes.
And then now we're kind of at capital efficiency and make sure your runway lasts.
Yes.
So when you consider that now the investors are in a buyer's market now, which means it's just deals for them.
Yeah.
What do you think the metric that they're really going to be? What do you think the metric is going to be going forward for, we'll say, 2023, and then emerging out of this problem optimistically in 2024?
I think I'll still pick net dollar retention. That's the one I'm hearing still a lot of buzz around is, how can you further monetize your existing customer base, and truly understand the path to that, because that's what gets the SaaS flywheel going. I see lots. Yeah, that's my short answer. Net dollar retention, keep focused on that.
And so for the companies that are under $1 million ARR, I mean, they always had to be capital efficient with a run rate anyways. So has anything changed much for them? Because their year last year wasn't so bad. Like in terms of those who raised, valuations were up, at least in the US for the seed, and early stage was more or less flat.
Yeah.
So I mean, like if you had something and you got, the money, did it really change for you? Because you have to be bootstrapped really until you get that Series A, typically.
True. Although now they have to grow into those valuations in a slowing market. And so that's the challenge for those earlier stage companies. How are you going to get a growth rate that's going to let you grow into what you were valued at? That's where I see those really early stage companies focused and challenged as sales cycles lengthen and, customers really are much tighter with their own wallets. That's their huge challenge.
Well, with SaaS and specifically, enterprise or B2B, a lot of it is optimization. Like you have like two sides of it. So you're either helping the company to gain more sales and working something on the sales side, or you're helping the company somewhere on the optimization side or cost cutting side.
Yeah.
So,
and I'd add reduce risk. You're helping them reduce risk as well would be another good one.
Okay.
Yeah.
And so going into a recession, do you think it's, if you're on the optimization side?
Yeah, that's good.
Like, are you going to have that much problems going into your growth? Do you think they won't be as interested? Like if I were to guess, I would say those SaaS companies are the ones that are probably going to be able to be less, I would say, pressured by investors for less optimal deals because they might be growing.
Yeah, I think you're right. I think everyone is looking for efficiencies right now. All of my clients are saying, Lauren, how can you help us find more efficiencies of the larger stage and even earlier? I agree. If you've got, you need to find a story around how can you help your customers be efficient if you don't have one. Yes, they all want to grow their top line revenue, but I'm with you. I think that's huge right now.
Yeah. That's what I'm always telling my companies anyways.
Yeah.
If you're thinking in terms of the rule of 40, where are you turning the tap on and off? Yeah. And with which investor do you need to turn which tap on and off with?
Yeah.
Is typically what, I'm telling them. So you said you've recently got into angel investing, or you've been doing it for a while?
Just recently dipped my toe in the waters through Capital Angel Network and Sheboot.
Yeah. Okay. And have you done many investments yet, or you're still at the analysis stage?
I've done a few investments. Yeah, I have made a few investments. Actually, only one in a SaaS company. The other three were across, I guess I would say, femtech and clean tech. Really compelling value propositions, disruptive technology. So that's what appealed to me. In the SaaS company, it was, it's a relatively untapped space with a huge need that was exposed during COVID to digitize some really patient communications with families and caregivers in long-term homes, which we all know the challenges of that. So that's been fascinating to understand. At the angel stage, there isn't a ton of data around these companies. And so, my knowledge of SaaS metrics and those kinds of things, I can help the portfolio companies I'm investing in as they grow. But to use those as analytics to help make decisions, it's often much too early. So that's been an interesting lens.
Yeah, so you have to rely on a lot of, I would say, qualitative attributes. I think it's all about the founder.
Yeah. But the founder, the market. Yeah.
Yeah. I mean, the market, for me, because I'm going through so many decks, I just assume the market is big and you're just going to give me a Gartner reference at the bottom of the slide.
Right.
So it's like, I could just click on it and be like, okay, yes, it really is 1 billion people.
Yes.
Or whichever it is. Yeah. Because otherwise there's no point. Because if you're doing venture, or I would say angel, which is high risk, it's supposed to be high risk, high reward. So you shouldn't be offering a niche business. That's more for bankers, lifestyle businesses. And then I'd be looking at IP. So What type of intellectual property does it really matter?
Yes.
In some cases, it doesn't always. It depends on what, the industry they're in and what they're doing. So I would look at that. Again, back to my comment about community management and marketing.
Yeah.
Does your brand have any actual value? Have you put in anything that I could give you some sort of, okay, you're doing something with this? And then, of course, the founders. Like that's the big point. Are they going to stick it? Are they going to stick this out for 10 years?
Yeah.
Because that's really what you got to be looking for. I know, we say it's going to be 5 years and you're going to exit, and it never is. SaaS, it's gotten longer. I think optimistically, you're probably looking at 10.
Yeah.
Like really optimistically for software, unless you just hit a home run in a niche place.
No, you're right. Yeah, it's interesting. So for the companies where I've invested, everyone's got battle scars. So there are two things. And I would be so interested to hear, although they might not share it because it's probably their secret sauce, but what investors look for in founders. There's been a lot written. For me, what really appealed was some battle scars, wherever those come from. Like, have they overcome incredible obstacles in their past? And what is the passion that is coming from a place deep inside of the purpose for why they're building this company? If you connect those two things, lots can happen, but at least those two criteria really seem to be a good combination, track record.
Yeah, I know. I agree. Having some passion for what it is that they're doing.
Yeah.
It also makes it so much easier because a lot of founders are technical. They're not the best at presenting, but if it is something they're truly passionate about, it comes out more naturally and it's easier for them.
Yeah.
Which I think is great. The other kind of attribute I like, but it's also contradictory to itself, because it's like two pieces on the spectrum. Okay. So I want them to be, to a certain point, coachable.
Yes.
And not be kind of like, I know everything.
Yes.
But at the same time, you need to kind of be the leader and also have, believe in what you're doing.
Yes.
And so there needs to be a certain level of not being coachable, sort of that stubbornness of, I'm going to Mars, even though everybody thinks it's a terrible idea. So,
yeah, I love the way you said that. You're right. It's this tension. And investors need to know founders need to know when to move themselves across that spectrum so that they are finding the right balance. You're right. They got to be 100% determined, plow through all the obstacles. We're building a huge business, but then take in the coaching when it's the right thing to do. That is so difficult.
Yeah, because certain things you want them to be resistant to the consulting or the advising.
Yes.
Right? But being resistant to the right part of that.
Yes. I agree. And I've seen some really early stage founders that haven't found that quite right mix yet. And so they're swaying all over the place and they're just contorting to all the latest advice rather than absorbing it, analyzing it, and picking. Maybe they make a bit of a tweak in their trajectory, but they don't totally zig, totally zag, totally zig, totally zag. That's a learned skill. Yeah, 100%.
And then another thing that I like, these other attributes, they're not 100% yes or no. It just might sway me a little bit more. And one is you worked in something. Yeah. Because sometimes I come across founders that are very technical, like they learn their skills and they're able to build tech, but they make a lot of assumptions about the problem from the outside, despite talking to customers who might not tell them everything. And so I like the founders that are building something for an industry they've spent some time in.
Yes, love that.
It doesn't have to be, 25 years or something like that, but just enough time that it's not really like I'm the arrogant, builder of products and I can tell that this is your problem and I have the solution and then you should just do that.
Yes.
When they're in the inside, they saw the problem, they saw the frustrations of people dealing with it, and they decided, you know what? I could do it better.
I can do it better.
I've experienced how terrible it was.
Yeah. I love that you said that. There's 3 that have come across my desk in the last 6 months where the founders were running a successful services business for years and built their own internal tools to make their services business more efficiently and have spun those up into SaaS companies. One is in association management. One is in kind of learning. Actually, 2 were in learning, supporting instructional design work and then supporting sales enablement work. So yeah, that's interesting because they've got deep expertise. They've built these amazing, efficient productivity suites of tools in a very specific vertical, and now they're going to market. Love that.
And then the other 2, they're not 100% required. It's a pattern I've noticed. And so I might give some extra weight to it. At the end of the day, I am, I'm more about the outcome. So these are not 100% yes.
Yeah.
But I do find that new Canadians, they have a different hustle to them.
Yep.
And so I would be probably a little bit swayed in that direction. And I would also be swayed in the same way for someone who comes from an entrepreneurial family.
Interesting. Yeah.
Because I've met a lot of entrepreneurs that their parents were entrepreneurs.
Yes.
And so instead of going to university and maybe getting a professional degree, they didn't do that. Or they will do they're like the dropout, they'll go and do a little bit, but they learned a lot just being raised by entrepreneurs, not realizing that was their education.
100%. I know there's data out there. I don't have it at my fingertips, but there's data out there on the percentage of Canadian entrepreneurs who are new Canadians or who have come to Canada from other countries. Yeah.
Well, the thing I like about the new Canadians is they view, at least from those that I've interacted with, they have less of a safety net.
Yeah.
Whereas, a Canadian is more like, I'm going to try this out and see if I like it.
Mm-hmm.
And if I don't like it, I could go do something else.
Mm-hmm. 100%.
But a lot of the new Canadians are kind of, even though there is a safety net here in general, but they still kind of look at it as, this is my shot and I got to go. And I got to go and do it.
Yeah.
And, with the children of entrepreneurs, the thing I like about them is that they got like 20 years of education in entrepreneurship, but they don't realize maybe that they got it.
They've seen the ups and downs and they know how it works out, how it turns out. Yeah. 100%.
And so they have sort of this intuitive business knowledge.
Yes.
That they have. Although they might not be able to articulate the same way, it's just there from instinct because they had to work in their parents' business.
Yeah.
And they had to hear about the conversations between their parents about the business and all that kind of stuff. And then there's also the thing that, my parents made this business, I got to make one too. And, that sort of
continues. Yes.
Yes. So those are some of the, I would say, qualitative things that I like. That I look for when you can't measure metrics.
Yeah, those are great. And as I learn, and again, I'm just starting out on this angel investing journey, but as I learn more, I'll probably refine my hypothesis as well on that and my thesis, but all good.
Well, there's always new data coming out. There's always different stuff. So, it's always going to be changing and what the market demands for the winners. So with that, let's move to the end part, which is my question time. So the first general question that I have is, are you reading anything right now? And if you're not a reader, are you listening to something right now that you'd like to share?
Yeah, I generally read I generally read fiction, actually, when I'm not at work to unwind. So those probably aren't as relevant. I read and reread and refer to a couple of books all the time. So customer success books, and also just recently refreshed on, how to win strategy. I do enjoy, those are really probably the top things right now. I don't read a lot of business books.
No, this is great because finding good fiction books is a challenge too. And so I just finally finished the Asimov Foundation series.
Okay.
Technically I finished it. It's been a couple of years.
Yep.
You know? Like I didn't read it all at once. And I don't know if you are aware of that series.
I haven't read it.
It's an occult classic with the Silicon Valley people.
All right.
It's also just a famous author as well. Apple did make a series. It sounded like I'm doing a commercial for them.
Yeah.
But I originally just read it because one of these tech billionaires said it was his favorite book.
Oh, okay.
And
good.
or influencing book when he was a child. And so I usually try to read these books and be like, what are these guys up to? Because Steve Jobs was 1984.
Yeah.
Which makes sense.
Cool.
The closed ecosystem makes sense. And I currently do not have sort of my fiction books lined up for the year. I'm thinking about reading, I think it's called The Three Problems.
Okay.
I don't know if you've heard of it.
I have heard of it.
And I think it's about robotics, but I'm not sure. So that's one I have on my list.
Good.
Do you have any cool, fiction one that you'd like to maybe share? Maybe someone was looking for some ideas.
Well, I read, so I'm not sure if this will appeal to your audience, but I really got engaged. And so I read it to take my mind off things. The Seven Husbands of Evelyn Hugo was a great fiction book. Made me think of Liz Taylor. And so that's probably one I would leave you with.
So who's the Hugo person?
Seven Husbands of Evelyn Hugo. It's totally fiction.
Okay. So it's not loosely based on anything or satire?
It's based on Elizabeth Taylor's life, personally, after having read it. But it's on the New York Times bestseller list and was a really easy read just to kind of reset your mind after a long day looking at numbers. Read a good story.
Cool. Well, I mean, this question just has not been working. So, I'll put it out there anyways.
Okay, we might have to edit it out.
But usually, I'm asking about television shows. So, have you gotten into The Last of Us, which is an HBO dystopian show?
Oh, okay.
The reason I like it is because it's based on a real thing. And a real thing in nature, but taken to the extreme.
Ooh, okay.
So what I would recommend is watch the opening scene of the first episode. You can find it on YouTube where the scientists are talking about it.
Yeah.
It makes you think this is going to be like, is this going to be a pandemic thing? And it sort of is, but with zombies, but not zombies, because it's all about fungus.
Oh, interesting.
And so if you're aware or not, there is a fungus that gets into ants and takes over their brain. And
into ants?
Yes.
Wow.
And it makes the ant climb to the highest tree point so that a bird will eat it, because the fungus's objective is to get into the bird. And so this whole show is about this fungus has evolved to now get into human beings.
Oh my gosh, I love it. That's really mind-blowing.
So
yeah. The Last of Us. Okay. Well, interestingly, so my brother is a biologist, a PhD biologist, a professor out in Western Canada, and he studies a fungus that grows on the nose of bats, white nose fungus syndrome fungus, and it causes the bats to come out of hibernation. And so they die in the winter in massive numbers because of this fungus. So fungi, I'm not sure what the plural is, but it's a real threat to the natural ecosystem. So I could see that being fascinating.
Yeah, I think your brother might be aware of this show, but it's like it's really cool to find a case for zombification in nature. All right. So before we wrap up here, is there anything you would like to plug, promote, etc.?
Yeah, I would love to encourage both investors and SaaS founders to check out the benchmarks that are on SaaScan.ca/benchmarks. They're free. You can anonymous no strings attached. You can come here and on, a number of SaaS metrics, benchmark your company or your portfolio company's performance. Data set of 878 companies, and we're about to open the survey again this year. Check it out. You won't be disappointed.
I'm sorry, when does the survey open?
Survey opens end of February, and it will run through March for data collection.
Okay, perfect. Well, thank you very much, Lauren, for joining me today to talk about metrics and fungi and all other kinds of things. It was really great to have you on.
Thank you, Josh. Pleasure to be here.
You can find information about the Candid Capital podcast on the website, LinkedIn, and Twitter. Episodes can be found on Spotify and other podcast platforms. A quick reminder that this is infotainment and is not intended to be professional advice, malicious, or hateful. The views, information, or opinions expressed during the podcast are solely those of the individuals involved and do not represent those of employers, partners, and their subsequent connected private and public associations or organizations.
We canned it, I hope you understand it. Your business growth, we planned it, yeah. This ain't for sure, we stamped it, yeah. No FOMO, everyone come join, no solo. This all factual, from me to you, this Candid Capital.